Good morning, everyone, and welcome back to the channel. As we head into Wednesday's pre-market session, all eyes are once again on NIO stock. After a difficult start to the week, Tuesday brought more pain with NIO closing down 2% at $4.50 per share. It's a continuation of a disappointing trend that's left investors and traders alike wondering whether the bullish breakout we hoped for was just a false start, or simply a setup for a stronger move ahead. In this video, we're going to break down NIO's latest price action, the key reasons behind the current market sentiment, and the case for why optimism might still be justified. Let's dive in. Let's start with a quick look at the week so far. Monday's trade saw a sharp drop of about 8%, sparked by year-on-year delivery numbers that came in just slightly lower than expected. While the decline wasn't massive in terms of volume, it was enough to spark concerns about NIO's ability to maintain momentum in a competitive Chinese EV market. Tuesday looked like it might offer some relief. NIO opened slightly higher, up about 8 cents, giving hope that the bulls might be staging a comeback. But that optimism was short-lived. Within the first 30 minutes, the stock began trending downward and never really recovered, eventually closing at $4.50, shaving off another 10 cents from the share price. Importantly, broader market weakness may have played a role here. The Nasdaq, S&P 500, and Dow Jones were all trading in the red, weighed down by macro concerns including interest rate expectations, geopolitical tensions, and uncertainty around Chinese economic data. In that context, NIO's drop seems a little less dramatic, and possibly more driven by fear than fundamentals. So what about those delivery numbers that kicked this off? NIO reported a modest decline in vehicle deliveries compared to the same time last year. Now, while year-on-year drops usually trigger concern, context is crucial here. NIO is in the midst of launching new models, restructuring production lines, and optimizing cost structures. These moves often create a short-term drag on output before paying off in future quarters. It's also worth remembering that the Chinese EV market has become increasingly price-sensitive. NIO has held back from joining the brutal price war led by Tesla and BYD, and while that might lose them some short-term volume, it arguably positions the brand as a premium alternative. If they succeed in carving out that niche, delivery figures could bounce back sharply once new models hit full-scale production. From a technical perspective, the stock is at a critical point. $4.50 is flirting dangerously close to recent support levels, and if it breaks below this zone with volume, we could see a move toward the $4.20 range. But here's where it gets interesting. RSI levels are nearing oversold territory, and volume hasn't shown massive bearish conviction, which could suggest we're seeing temporary weakness rather than a structural breakdown. In fact, if bulls can hold the line at $4.50 and we get a small catalyst, the stock could quickly push back above $4.80, with potential to retest the $5 level again. So yes, the near-term technicals are shaky, but they're also not disastrous. What matters now is whether traders see value at this level, and what NIO does next. Despite the current sentiment, there are legitimate reasons to be optimistic. First, NIO is expected to provide more details soon about its new battery swap technology and second-gen power stations. These are differentiators in a crowded market and are key to NIO's long-term thesis. Any positive update could reignite interest. Second, macroeconomic headwinds could begin to ease. There are signs that the Chinese government is preparing stimulus moves to support the EV industry and broader economy. If that becomes more concrete, NIO stands to benefit. Third, NIO's long-awaited entry into Europe, particularly Germany and the Netherlands, is still unfolding. While international expansion has its challenges, it also brings potential for a second leg of growth that the domestic market can't offer alone. Lastly, don't underestimate the power of sentiment reversals. We've seen it before. When sentiment gets too negative and the fundamentals haven't truly collapsed, sharp rallies can follow. All it takes is one decent headline or earnings surprise to flip the script. It's fair to say that investor morale has taken a hit this week. There's a sense of déjà vu, a fear that NIO will keep teasing a breakout only to disappoint. But long-term investors might take a different view. NIO is sitting on valuable intellectual property, a loyal customer base, and a government that is unlikely to let its high-tech champions fail. It's also no small feat to be producing tens of thousands of vehicles per month in one of the world's most complex markets. Could the road ahead be bumpy? Absolutely. But when you zoom out, you still see a company building infrastructure, innovating its battery and power solutions, and staying committed to its brand. That's not a company in decline, that's a company in transition. For swing traders or long-term holders, This week could be seen as an opportunity, not a warning sign. Stocks don't move in straight lines, and NIO has always been a stock that rewards patience, eventually. So as we head into Wednesday, the theme for NIO is simple: hold the line. $4.50 is an important test. Can the bulls show up? Will the market find its footing? And is there a surprise catalyst waiting just around the corner? Only time will tell. But for those willing to zoom out and see the full picture, the thesis for NIO is far from broken. It's just evolving. Thanks for watching. Don't forget to like, subscribe, and drop a comment below with your thoughts. Are you buying this dip, or staying on the sidelines? Let me know, and I'll see you in the next one.